Welcome to Alpha Recap. I'm Lucy. Today we're unpacking a narrow, leadership-driven market day. Big tech rallied after a strong Apple print, but small caps and microcaps saw some nasty moves. Joining me is Benjamin, commodities expert based in Australia. Ben, great to have you.
Thanks, Lucy. Good to be here. Lots to sift through from today, so let's jump in.
Start us off with the top-line market picture. What happened on the tape?
Sure, the headline was a narrow risk-on session. The big cap tech names led the way and pushed the major indices a touch higher. The S&P finished up about 0.5%. Nasdaq-heavy benchmarks did a little better. The big tech index climbed about 0.8%. But the Russell, our small cap gauge, actually slipped, down roughly 0.2%. So it wasn't a broad-based rally. It was really a leadership-led move.
When you say narrow, what does that mean in plain English for listeners?
Good question. Narrow means only a handful of big names were doing the heavy lifting. Think of a few megacaps pulling the market up, while a lot of other stocks either didn't move or went the other way. It's like a parade with 5 floats and an empty street. It can look impressive, but it's fragile. If 1 or 2 leaders stumble, the whole thing can falter because there isn't broad participation behind it.
Apple was the standout today. Walk us through why Apple mattered and the market reaction.
Apple reported adjusted earnings per share growth of about 13%. That's a solid beat, and it speaks to 2 things investors care about: hardware demand holding up and services revenue staying resilient. For traders, that's an easy story to buy into. If Apple's customers are spending, then a bunch of related suppliers and large cap tech names look healthier. So flows chased those names, and that helped the indexes, even though most smaller names didn't participate.
Beyond Apple, which sectors stood out and why?
A few sectors caught bids. Utilities did well because there's renewed chatter about grid projects and merger activity. Investors like utilities when they want stability and yield. Materials and mining saw flows too, largely into firms with visible project pipelines rather than broad industrial exposure. Energy was mixed. Upstream companies with clear cash flow did better, but speculative midstream and exploration stocks lagged. Communication services and other tech pockets benefited from selective ad and streaming optimism. And financials were a mixed bag, although Qatar National Bank beat expectations, and that points to pockets of resilience.
You mentioned defensive cyclicals earlier. Can you explain that term and why investors were rotating there?
Absolutely. Defensive cyclicals are companies that have some exposure to the economic cycle, but also offer defensive traits like predictable cash flow or dividends. Utilities are the classic example. Investors rotate into them when they want some upside if the cycle improves, but also protection if things get shaky. In today's environment, with headline risks like tariffs and geopolitics, that combination makes them attractive.
The report flagged cannabis as a drag. What's the issue there?
Cannabis remains hostage to policy uncertainty. Without a clear federal signal or meaningful state-level catalysts, those stocks have limited visibility. That means any piece of headline news can swing them dramatically, and right now the headlines aren't offering clarity. Traders see that and stay away or trade it in a headline-driven, high-volatility way.
There were some jaw-dropping moves in microcaps today. Some names down 30 to 37%. Why are microcaps so volatile?
Microcaps are thinly traded, so a modest number of sellers can gap the price down sharply. Add company-specific bad news, liquidity squeezes, or regulatory headlines, and the move can amplify. Those big percentage drops are painful and remind investors that position sizing and liquidity matter a lot in that space.
Let's pivot to the macro and the Fed. Did anything today change the policy outlook?
Not really. There weren't any seismic macro prints to move the Fed outlook. The takeaway is more subtle. Flows into higher quality cyclicals and yield-bearing names suggest the market isn't expecting imminent rate cuts. Participants are treating policy as a moderating backdrop and rotating tactically. But if inflation prints come in hotter than expected, or Fed speakers get hawkish, those richly valued growth leaders could get repriced quickly.
So, investors should be watching inflation data and Fed comments closely.
Exactly. Upcoming inflation measures and Fed speeches are top of the list. Earnings commentary is also key. Companies talking about costs, pricing power, and demand can shape expectations for growth and for Fed policy down the road.
Tariff rhetoric was mentioned as a live risk. What should listeners pay attention to there?
Tariffs hit supply chains and margins. Watch announcements targeting industrial goods, autos, machinery, or components. If new tariffs are floated, the immediate impact is on companies with complex global supply chains. Think parts manufacturers and auto suppliers. Traders should monitor headlines and any company commentary on exposure because tariffs can force sudden repricing in affected names.
Any other notable individual stock calls from the day besides Apple?
A few. Nike was highlighted for possible inclusion in an exclusive index club, which speaks to its brand and margin upside if premium demand recovers. Dowlais Group, an engineering name, reported performance ahead of guidance and got rewarded. That's an example of investors paying up for visible project pipelines. Allergy Therapeutics showed about 7% revenue growth in the first half, which is meaningful in the biotech niche. And as I said earlier, Qatar National Bank beat fourth quarter expectations, showing credit discipline in some pockets of banking.
Technically, you said this looks like past episodes where leadership concentration can either broaden or precede a correction. How do you read today's setup?
The setup is classic leadership-driven strength. Historically, there are two outcomes. One, leaders continue to do well, and eventually the rally broadens into mid and small caps. That's the healthy path. Two, leadership stumbles, and because breadth is weak, the market can sell off sharply. Right now, we haven't seen that broader participation yet, so it's still vulnerable. Investors want to see the Russell start outperforming the S&P as a sign the move is sustainable.
For traders and investors listening, what should they watch tomorrow and in the next few sessions?
Keep an eye on a handful of things. 1. The earnings calendar. Another megacap beat could keep the tape going. 2. Inflation prints and any Fed commentary. 3. Tariff headlines and supply chain related announcements. 4. Any legislative or major policy signals on cannabis. 5. Breadth measures, whether mid and small caps start to join the rally. And 6. Continued microcap volatility. If you trade, size positions carefully in thin names and be ready for headline-driven moves.
Give our listeners 3 quick takeaways to end with.
1. Today was a narrow rally led by megacap tech, with Apple's roughly 13% EPS growth a clear catalyst. 2. Small caps and microcaps lagged or got hammered in places. That highlights liquidity and policy risk. So, manage position sizes. 3. Watch incoming inflation data, Fed speakers, tariff headlines, and breadth. Those will determine whether this leadership-driven move broadens or rolls over.
Perfect. Ben, thanks for that crisp rundown. That's all for today's Alpha Recap. I'm Lucy. Thanks for listening, and we'll be back tomorrow with more market colour.
Thanks, Lucy. Talk soon.